Welcome to ESG Decoded, where we unravel the business complexities at the intersection of environmental, social, and governance issues.
I'm Erika Schiller, and I'm joined by my ClimeCo colleagues, Emma Cox and Anna Stablum.
Get ready to explore the intersection of sustainability, innovation, and ethical leadership, the dynamic forces shaping our global economy.
From climate action to social responsibility, we're here to decode the ESG landscape by interviewing interesting leading figures across the globe that will empower you with actionable insights.
Whether you're a seasoned practitioner or just embarking on your sustainability journey, this podcast is your compass for navigating the future of responsible business practices.
Let's decode ESG together. Special thanks to Amazon Sustainability for their support and sponsorship of this episode. Amazon is known for speed and scale. That same approach now drives their sustainability efforts. Guided by data and science and powered by invention, Amazon works backward from ambitious targets to drive measurable progress. Amazon has delivered 1.5 billion packages by electric delivery vehicles globally. They're also building the largest carbon-free energy portfolio of any corporation globally, with over 700 carbon-free energy projects worldwide. Every delivery and every data center is an opportunity to move forward. Learn more at sustainability.aboutamazon.com. Hello everyone, and welcome to another episode of ESG Decoded. Today I have an amazing guest with me from Prudential plc. It's a UK headquartered firm offering their clients investment, retirement and insurance services. So very welcome to the show, Liza Jansen. Liza is head of responsible investments, which means that she's in charge of the ESG strategy for all markets in which Prudential operates across Asia and Africa. Before joining Prudential, she was an investment strategist at the Dutch pension fund PGGM, where she focused on responsible investments and strategic asset allocation. I am so excited to have you with us today, and we will focus on two topics: how to unlock financing to combat climate change, and how the climate crisis will most likely start or accelerate, as it feels like we're already seeing the first signs of an insurance crisis. But first, maybe Liza, I'm sure the listeners would like to get to know you a little bit better. So what are you doing on a day-to-day basis, and what has brought you to this role and also to Asia?
Okay, so as Anna said, I'm the head of responsible investment for Prudential plc. So we're a life and health insurer, meaning that we're an asset owner. So we collect premiums on our products, and those premiums are being invested. And basically what I try to do is make sure that we invest it in a more sustainable way. So as an asset owner, we play a very specific role within the financial industry. We can invest into a range of different asset classes. So we invest in listed equity and corporate bonds, but also private equity, infrastructure equity. But we have to invest through an asset manager due to regulatory concerns. So as the asset owner, we can decide, of course, how to invest. We can give quite a lot of requirements for the asset managers that they need to follow. We, of course, decide which kind of funds and which kind of asset manager to invest with. But that's kind of my role. I set the responsible investment requirements for how we invest these assets. And that ranges from things we don't want to invest in, like exclusions, which in general we're not so keen on, but also what we really like to invest in, which is one of the programs financing the transition, focusing on climate change. But we also have decarbonization targets for our investment portfolio. And we can do engagement, especially the engagement that's done with the investee companies. That's being done by the asset manager, but still we set the requirements for engagement, making sure that the asset manager is actually doing what we like them to do. So it's more a strategic goal within responsible investment. It's setting frameworks, it's setting target setting, strategy setting for Prudential. The actual implementation is very often done by the asset manager because they are the ones that actually go out into the market and buy the assets for us.
That's great. That's very helpful because it is a bit confusing, I think, between an asset owner and an asset manager. And that's something that we might come back and talk a little bit more about. But I think it is important, like you said, that you're setting the frameworks, if I understand it correctly. But then it's the asset manager, asset manager that would come, for example, to a company's AGM and be more of a steward and work the interests that you have already given them. And of course, target those investments, like you say, in the way that you would like. It means, of course, that you have a lot of money. And at this point, I'm so curious and interested in understanding, because, of course, as you know, the scale of finance needed at this point of time to combat climate change is massive, right? And of course, people are talking about the trillions. I've just got one number in front of me that basically emerging markets and developing countries, and it even excludes China. They will need some 2.3 trillion to 2.5 trillion a year by 2030 to meet climate goals. And of course, this is some 4 times more than what is currently invested. You guys have money to invest. You know, what role can you and Prudential play, if any, basically to put that money at work when it comes to adaptation, mitigation, and of course your expertise, sustainable investments?
Yeah, so that's what I'm trying to do. Trying to get more investments into these kind of topics. Within responsible investment, I focus on all kind of sustainability topics, but climate change is one of the most important ones. And I believe especially asset owners have a very large role to play in financing this energy transition. But of course, we have our own limitations as well. We're life and health insurer. People trust, their capital to us and get products back for them, savings or insurance products. We always have, but we have a fiduciary duty. We always have to act in the best interest of the policyholder. But at the same time, being especially life and health insurer, we're also a very long-term investor because these products tend to be quite long-term. Our liabilities are long-term. So we have to pay out some products on a very long term, like 10, 20 years. So that means we also have to invest for that term. And then especially sustainability risks and of course climate change become a very much financially material risk for our portfolio. So part of our fiduciary duty is actually taking those sustainability risks into account when we make investment decisions. Because we know there's an energy transition going on. There are policy interventions, especially now with new technologies and, economic costs are going down. It's a huge opportunity, but we also know there are going to be losers in this energy transition because it's just prudent risk management to take those things into account. And then, of course, when you talk about physical impact of climate change, that's going to have very big impact on the world, in general economic growth, but also on the corporates we invest. So we have to integrate these considerations into our investment process. But then at the same time, it's in our best interest if the world, of course, transitions. Because especially, we're a very old company. We hope to stay in this much longer. So we have to be prepared for these very large shifts that are happening within the economy. And just in general, the impact of climate change that it has on economic growth, on people's income. For us, it's best if the world transitions as quickly as possible. We meet the goals of the Paris Agreement, because that way we keep the cost of physical impact of climate change limited, and overall that will be the best outcome for us. But I also see financing the transition and actually trying to put money towards climate mitigation adaptation as a way to overall mitigate our risk. Because the faster the world transition, the better it is for us. The challenge is mostly for emerging markets. And for Prudential, that's where we operate. So we're originally a UK company, but now completely focusing on Asia and Africa. But we're a very interesting investor because we're a global investor. and a very local one. So we operate, for example, in Singapore and Hong Kong. In these markets, we can invest globally. So then we're a very global investor. But we also operate in some very frontier markets like Vietnam, Philippines, Cambodia. There we have to invest locally. So we have kind of both aspects where we try to do more climate change investments globally, but then also in our local markets. And the financing gap is the largest for emerging markets. And that's the big challenge for the world in general, because most of the carbon emissions are currently coming from emerging markets, even though historically they have contributed the least to the problem, but also going forward. Any increase in carbon emissions is all going to come from emerging markets into economic growth, population growth, and now also data centers and AI, where they're all still looking more towards emerging markets. And that's going to be the huge challenge. We need to get more financing into emerging markets, because whether globally we're meeting net zero, that's going to be decided in the emerging markets. And those are the places that it's hardest to invest in, because emerging markets are riskier. Sometimes the perceived risk is higher than the actual risk, actually, because investors think it's riskier than it actually is. But still, you also have risk, how it's seen by the regulator. So the regulator sometimes puts in incentives not to invest too much in emerging markets. But I think within that fiduciary duty and within the regulatory framework that we have to operate in, we can try to push more of our capital towards these kind of topics. And we set a target, an AUM target, on financing the transition investments. And that so far has been going well, but it just gives like the additional push. Of course, we need to worry about diversification. We can't put all of our capital into climate change, because you just need to manage regular risk as well, of course. But that doesn't mean we can't do more, especially as asset owners, because we have so much say in how we invest our capital, despite having to go through an asset manager. And that's actually a very interesting relationship, where asset managers really like to know what the asset owners think are important and how they can help them reaching more their long-term goals.
Well, that's a lot to unpack there, and that is super interesting, Lisa. I find it so interesting. And maybe just to get a few topics, dig deeper in a few of the things that you said there. One, I thought was interesting, you're saying, we're seeing this shift, right, into or within this energy transition that we're basically part of at this point of time. Could you give us some examples where, for example, you were also mentioning that you do have a few exclusions where you cannot invest? Have you added some more on that exclusion list as this green transition is now underway? And are you really looking for certain investment areas in order to move that shift forward?
So what we do is we are in general not too much in favor of exclusions, mainly because the sustainability impact is highly questionable, whether it's actually having a positive impact on the world, but also because it's going to have an impact on our portfolio as well. But we still have exclusions in place for life and health insurance. We insure people, so we're not investing in tobacco, we're not investing in controversial weapons due to the large impact on quality of life of people. But the climate-related one is that we don't finance any companies that are too reliant on coal. So the coal mining companies or utility companies that generate electricity by coal, and we usually use it 30% of revenue cut off. But in general, these companies still need to transition. So we don't want to be too strict on those companies, especially not in emerging markets, because they have very challenging actually for them to transition, considering the economic growth and the population growth, just the increase in electricity demand, also through electrification. And some countries really struggle meeting those increase in electricity demand by renewable energy, and then also transforming its current electricity system. We're more in favor of financing the transition and engagement, so talking to the companies and see what they can do on the transition. And financing the transition is a very specific program for Prudential. So we actually came up with our own framework on how we think we should be financing the energy transition. We tried to align as much as possible to industry standards. But as I said, Prudential operates mostly in emerging markets. And emerging markets have always been key to our business strategy, but also our responsible investment strategy. And emerging markets, we see need a bit more flexibility. They're still very carbon intensive. So in addition to investments that are already green, which are like solar panels and windmills and things like that resonate very well with people, we also need financing for things that are currently carbon intensive, but needs capital to decarbonize over time. And then you're thinking about things like steel or cement. We're still going to need all of those products, but they need capital to just decarbonize. And moving away from all of your carbon intensive investments in your portfolio is not going to help them to transition. So we specifically include these kind of investments, what we're calling brown to green, where the companies or projects do have a very credible transition plan in place. And then what makes Prudential quite unique with this particular framework is that we also added flexibility for emerging markets. We refer back to the Paris Agreement, and we, of course, almost globally, decided to keep the global warming to 1.5 degrees or below 2 degrees. Within the Paris Agreement, there is actually a principle included called the Common but Differentiated Responsibilities Principle, which basically says some countries have more ability to act and also have more responsibility to act because they contributed more to the problem. So we interpret that a little bit for developed versus emerging markets. That's how it's usually interpreted. So what we're trying to actively do is we're trying not to just take standards and decarbonization pathways from the developed markets, which have been designed there, and apply it to emerging markets as well. Because they need more flexibility. They just have very, very different challenges that we think we really need to take into account. They have a very different stage of economic development, for example. There haven't been any countries yet that have gotten rich over time, basically, without fossil fuels. And we're now asking emerging markets to do just that, to generate a lot of economic growth, but not using fossil fuels. And that's an incredibly difficult question. So we believe that emerging markets in that transition need more time and need a bit more flexibility, as is explained in the Paris Agreement. And we allow for that flexibility when we invest for energy transition. More so because what we've seen in the past is if you don't do that, you usually end up with investments in developed markets. If there's like a global investment fund that invests in companies and you have a sustainability overlay or a climate change overlay, usually the allocation towards emerging markets is halved, just because they don't meet those standards that we're applying to developed markets. And that's just not helping the energy transition, but we also don't think it's fair to do this. And that's why we came up with our own framework that's been working very well internally, finding these investments, but also going out into the market, sharing with asset managers what we like to see, sharing with policymakers that we allow for this flexibility. And we really want to see the countries come up with a pathway that works for them and that takes their unique circumstances into account, because otherwise it's going to be too hard for those countries to transition.
I find that interesting with a just transition, and I think it's something that if you live out, so you're based in KL in Kuala Lumpur, Malaysia at this point, and you really understand a lot better when you live in these countries as well, how the reality on the ground looks like. And this is something that, of course, we've also discussed a little bit when it comes to these frameworks that have been set up. You're part of the Net Zero Asset Owner Alliance, but there has been a lot of people leaving, for example, the Net Zero Banking Alliance. And this is something that we touched on when we last met, that some of those frameworks makes it almost impossible to actually be part of or follow. Do you mind sharing a little bit about your thoughts when it comes to these alliances and frameworks and various initiatives, of course, that might be very positive if you sit in the developed world, but it makes it quite tricky in the emerging markets and the developing space?
So I think there are actually two parts to that answer. We are a member of the Net Zero Asset Owner Alliance, and the Net Zero Asset Owner Alliance is still going very strong. Great collaboration, and I strongly believe we needed collaboration amongst peers. so we can generate more impact. So we're not, not colluding on investments or anything, nothing like that. You're just sharing knowledge on how to find these kind of investments. But as an owner, we have quite, within regulatory and fiduciary duty constraints, you still have quite a lot of flexibility on how to invest. I think what went wrong with some of the other initiatives, like the Net Zero Asset Manager initiative and the banking one, is sometimes it went beyond a little bit to what they can do within their freedom of operation. All of these financial institutions are regulated, and they have a fiduciary duty as well. So there's only that much they can do. And it doesn't mean that we can't push them to be more ambitious, and we really should. But we do have to recognize that at some point their influence ends. And especially if the world is not transitioning, and we know the world is not transitioning fast enough to meet the goals of the Paris Agreement, and at some point that's going to clash, which I think was one of the challenges with these kind of initiatives. But another thing with these kind of initiatives is indeed they set a set of requirements that all of the members have to meet, like minimum requirements usually, and then something more ambitious. But the requirements are all coming from developed markets. And they're trying to pull in more asset owners or banks or whatever from emerging markets, but they don't recognize themselves in these kind of frameworks. So for them, it's very difficult to join. Just to give a very tangible example, everyone knows, of course, I think about net zero by 2050, because that's what we need to reach to meet the goals of the Paris Agreement. But the Paris Agreement, under the Paris Agreement, all countries are setting their own NDCs, and they have flexibility in setting their net zero targets. So China has a net zero target 2060, just like Indonesia, India has one for 2070. But all frameworks and everything is just still demanding net zero by 2050. And that's one of the things that we very specifically allow. If this is a company that operates in India and has a net zero target by 2070, or sometimes even 2060, which is very ambitious for that particular country compared to the NDC, we still see this transition finance. But many different frameworks don't see this as transition finance, or saying that new net zero target is too late, it's not credible. Even more difficult, really, sometimes not even finding the data on whether that company has set a net zero target, because the data provider is already saying it's not a credible target. We're not even including this in our data set on whether it has a net zero target. And this makes it all very, very difficult, because if you are an asset manager or bank operating in India, and you sign up to one of these initiatives that have very, very clear goals on net zero by 2050, you need to set a net zero target by 2050 as well. But your country's target is 2070. Of course, it's going to make it so much harder to sign up. But I think a lot of financial institutions operating in developed markets that invest globally have also come to realize this, because these are still the markets they invest in. And how do you work around these kind of things if you're not allowed to do these kind of investments, realizing that China, India, Indonesia are 3 out of the 4 largest countries in terms of population in the world. So if you want to have impact and you want to reduce carbon emissions, you should be looking at these countries.
And you're then set within that framework, like you say, that might actually not allow for the flexibility that you guys obviously are really pushing for. I wanted to move on and talk a little bit about nature and the highly dependent economies that we have on nature. So ecosystems are obviously very much threatened by climate change. And I believe that it's something like half of the global GDP, so around $44 trillion are highly dependent on nature. So if we look at nature specifically, what types of investments could Prudential do, and how will you be able to meet, the return on investments that I'm sure you have? How can you find enough big projects? And obviously you want to make money as well. How do you think about nature?
So we actually published a paper also on how we define nature investments, nature adaptation investments, just like our financing and transition framework, which is publicly available as well. And what we actually did is we noticed again, a couple challenges with how do we define nature investments. So first of all, one thing that we do is we included those as climate solutions into our financing the transition investments. Because nature, climate change, both mitigation and adaptation, they're all so interconnected. You actually can't do investments without taking the others into account, also from a do no significant harm principle. If you do mitigation investment, you have to think about the impacts that's going to have on nature and the other way around. That's a hard requirement for us anyway, and within the EU taxonomy as well. But that's because those topics are so interconnected. So that's why we decided to bring everything together, which also makes it easier to invest in them, because we can now combine climate change investments with nature investments, which just makes it easier to find them than dedicated nature funds, because dedicated nature funds are still very, very nascent, and it's a new topic. But usually when people think about nature investments, they think about reforestation, afforestation, kind of nature-based solutions like investing in mangroves, for example. And those are really, really needed, but rarely generate the return that we need. So as an institutional investor like us, our role in that kind of space is probably going to be a little bit limited. Hopefully it's going to change, and we're going to find a way how to make those investments not generate just an economic return, but also a financial return, which is what we need. We need that financial return. But for now, it's really challenging. And what we've been arguing, we need to look more at the indirect nature, what we are calling nature enablers as well. And these are things related to agriculture, to water, but also waste. These kind of investments have a huge impact on nature and the quality of nature. But it's not the first thing that usually people think about when they think about nature investments. But things like waste, recycling, these kind of are incredibly important to reduce the impact on nature, because usually a lot of the waste is eventually going to end up either in landfill or directly into nature. But even a landfill, of course, situated within nature, and it's contaminating the ground and everything. So these kind of things are incredibly important, but also for us important, more financially viable to invest in. And we think it's important that the industry in general comes up with a credible definition of what nature investments are, thinking with this more financial lens on what we can do as well. So I'm absolutely not advocating for greenwashing. It still needs to have a credible impact on nature. But having a little bit more flexibility for institutions like us would be really, really helpful. So we set our own definitions. No one's going to adopt those, obviously, because you're not going to adopt definitions of a peer or institution. But we're hoping to push industry standards and standard setters to come up with a definition that's going to work for the entire industry. We have it on climate mitigation. It started, of course, with the EU taxonomy. So we made great progress on that one. And we need the same thing for both nature and, by the way, adaptation as well. How are you going to adapt to the physical impacts of climate change?
And who could set such a framework? You mentioned the EU taxonomy. This is kind of the way that you would like to see a broader notion on nature as well in the taxonomies, or who would set that kind of framework, or who would take the lead on that?
It could be different kind of institutions. Indeed, for climate mitigation, it was the EU who set the taxonomy, which then a lot of other countries followed. But in the countries in which we operate, we often do some policy engagement, and we're arguing, start including nature and adaptation in those. But it could also be more like neutral organizations, like for climate mitigation, we've had GFANZ, it was the umbrella organization over all the net zero alliances within the financial industry. These kind of collaborative initiatives can set some standards like this. So it could be an industry initiative, could be policymakers, or even more neutral investors like IFC, part of the World Bank. These kind of global investors that they're not seen as a competitor. I think that's very important, because it needs to be some institution or body that's a bit more neutral
to take the lead. And basically, in these investments where we could potentially get a little bit more scale, like you mentioned, nature projects, afforestation projects are normally small in nature. and hard to get the return on investments from. So yeah, that's something that is urgent, I feel, and hopefully you and Prudential and the rest of your peers could push for those types of frameworks that we can get more money coming into activities are related to nature. But thank you for that, Liza. I wanted to move on again and look at you as an insurance company. And basically, some analysts are saying that this climate crisis will actually start as an insurance crisis because these rising climate-related disasters are making traditional insurance models unworkable and, of course, pushing up premiums, and coverage gets out of reach, especially for homes and farms and also infrastructure that are in the front lines of storms and fires, floods, etc. So do you mind explaining a little bit where, I know you are affected by climate change yourself, and this is something that you touched on, that this is why we need to invest sustainably, because of course we don't want climate change because it's actually affecting our operations and our profitability. Do you mind just explaining how are you affected, or where do you see the largest effects on your operations at this current time, and also what are you trying to navigate going forward?
Yeah, so we are a life and health insurer. So we insure people. Basically, I think I completely agree with the statement that I think this climate change crisis is going to be insurance crisis first. But I think most people starting are most visible probably for the general insurers that are insuring assets, that are insuring homes. We've already seen this in the US where insurance companies are pulling out. They're just not offering certain insurance anymore in California for forest fires, for example, which obviously is going to impact hugely the value of those assets, and it makes things more quickly not livable anymore compared to just really the direct physical impacts. But even as a life and health insurer, and this is territory that's been explored a little bit less in detail, it's still more challenging. But we see a very clear link between climate change and impact on people's health and just life expectancy as well. Of course, you have the acute risks. Flooding usually leads to some casualties, but it also leads to, in the tropical countries, to an increase in dengue, for example. And we see those kind of things in our portfolio. We're trying to manage those kind of risks as well. How do we account for these kind of things? Heat strokes, for example, are on the rise as well. And you can actually die from a heat stroke at some point. It's impossible for your body to manage that heat, and you just die. And these kind of things are becoming a lot more common, and we see those cases rising, and that's something we have to manage as an insurance company as well, making sure that we can continue to offer the products to our people and making sure that they can get good life and health insurance. But of course, these kind of risk, with these peaks where suddenly a lot of people are impacted, are the most difficult to manage for insurance companies. So whether it's a forest fire for a general insurer, or it's something with flooding for a life and health insurer, these kind of sudden spikes are just difficult to manage from a risk management perspective. We have to look carefully, how do we include this into our actuarial decisions, and how do we price certain products? But that's going to be challenging at some point. People are not being able to afford, for example, these kind of products anymore, especially if they also have a lot of expenses for their home. If their home is affected, they have a lot of expenses, they might choose to drop their health insurance because they need to make savings somewhere else. And that's, I think, a large risk as well, because leaving those people exposed and more vulnerable is in the long term, of course, not what we want and what we should want. And that's going to be, a key concern for governments as well. It's not just the direct impacts of these kind of natural events, I should say, like floodings and everything, but it's also going to have, the indirect effect on people, their property being destructed, but also people not being able to go to work anymore. It's going to affect economic growth and just in general well-being of people. So also governments and, ability to raise taxes. There's so many kind of economic effects that are going to ripple through the entire economy. That's probably how the crisis is going to start. It's going to be a financial crisis due to these huge economic secondary effects that these kind of events can trigger.
And I can't help but think we were talking about a just transition, and already you feel a bit that, of course, there are many people in the developing world and in these emerging markets that are very much exposed to these climate change events, like you were talking about floodings. Obviously, you gave the example about California, which is in a first world country, but of course you can't help but feel like a country like India, and you're talking about heat strokes. Could we potentially come to a time where, insurance companies, I mean, of course, you could increase the price of the insurance to such a degree that people cannot afford it anymore. But we might even come to a time where even in the developed world, that insurance companies are no longer interested in selling these types of insurances.
You could get there. The whole point of insurance is that we are pooling risk together for all different kinds of people, assuming that risk is only, that kind of event you're insuring yourself against is only going to happen against a limited number of people within that big pool. But as that number of people grows, and insurance just doesn't make that much sense anymore. Because if it's like an almost certain event, you can't find insurance for these kind of events, because then that's not how the insurance market works. You pool all people together so you can diversify the risk and overall can lower the risk. So if one person gets sick or something, because the other people are still healthy and pay their premiums, we can pay out. But if everyone at the same time gets sick, then, it's like a certain event, and then you just have to save for it. Because in general, insurance is, of course, especially if the event happens, it's just cheaper. You get paid out more than you've actually put in because you're sharing that risk with others. That's like the principle of how insurance works. But if it's a certain event, then whatever you pay in needs to match whatever the company has to pay out. So then you could also save yourself. So then at some point, it just doesn't make economic sense anymore to offer these kind of products. And then, of course, the insurance market is also quite regulated on how much premium they're allowed to ask. So that's also something to take into account that we've seen, for example, in the US. You can't just increase premiums to that level that actually covers the claims. Then especially companies are pulling back.
I know that insurance companies are obviously trying to find some solutions to this, if you'd like. Is there another way?
So I do think insurance company can also play a large role within catalyzing, especially preparing for these physical impacts. So they can put requirements into their policies, for example. I'm again talking about mostly general insurance because it's harder on the life and health side. But if you get a fire insurance for your home, you usually required to put in some sprinklers or something that, systems in place in case there is a fire. Actually, you try to lower the damage. And that's, of course, you can do so similar things. We do see this kind of starting, but you can do certain things for physical risk of climate change as well. You get a lower premium. You have certain requirements that you need to show that you're adapting, that you're prepared for these physical risks of climate change. So the insurance company can offer you that particular product. And I think they're going to be quite key into making sure that especially adaptation investments are gonna increase. So we get people and businesses to prepare themselves. But of course, there's only so much as a business you can do. There's only this famous picture of flooding in Thailand. There was this one building that was still standing, had like no damage, but everything else around it was just completely flooded. So you can't get there. Everything else, you don't have electricity or anything. So yes, that particular building was very well protected, and they put in stuff to make sure that they wouldn't be affected as much. But you're dependent on, where you live, your environment around you. So they're still very much impacted. So of course, there are limitations to what they can do. But insurance companies, I think, especially can be a catalyzer making sure more people and businesses start to prepare for these kind of rising risks.
Wow, it sounds quite scary, doesn't it? I just wanted to round up and a little bit again on the topic of the trillions that are needed. Do you have a good recipe for the world how we could actually get more money to work?
I think what we can do as individual institutions trying to push more for these type of investments, and we like to see them more, basically what we're doing. I think policy engagement is going to be incredibly important. We all know we need government intervention, and engaging with governments and policymakers, I believe, is quite effective, especially when they hear from businesses and the businesses that operate in their country how important that they find this. For emerging markets especially, I think we need to find a way how to catalyze more investments into emerging markets. And there are different things we can do. One of the most popular things that we hear about is blended finance. You have partially fixed capital that doesn't need your market rate of return because it's coming from a philanthropy or a government or multilateral development bank, for example. And they try to put risk reduction measures in place, or they lower their own return requirements, which allows investors like us to come in and invest in that type of vehicle as well. So we have, for example, a couple of these investments where we have catalytic capital that basically says we only need a certain percentage of return, which is lower than the expected return of that particular fund. And then the rest of the return gets distributed amongst the other investors, which raised our expected return to the level that we could actually invest, because otherwise we couldn't have done that investment. It's too high risk for the return that we were getting. And this is a particular emerging markets fund. And these kind of initiatives are really needed, trying to catalyze more capital into these type of projects, because that particular investor could also have done the investments themselves. But obviously, if you invest in a fund and you make sure that 4 or 5 institutional investors can also invest in the fund is going to be 5 times as large. And that's the kind of skill that we need. But these kind of financial innovations, we see them a lot in the market, but it's difficult to scale them. And it's also difficult to make sure that a lot of institutional investors can actually invest in them due to regulatory constraints and everything. So again, a point of engagement. In general, regulation is, of course, very good. These kind of financial institutions need to be regulated. But there are certain things we can, I think, change, making sure that these type of investments that in general are, which is good for us from a financial return perspective, and have that positive impact, that we can make those more investable.
I like that. And I think, like you say, there are these almost pilots going on, and we're seeing it talked about a lot, but more action is needed, right? More action is needed on behalf of governments and private institutions. But yeah, let's end the podcast here. I think that's a great takeaway, and hopefully we'll get more of those conversations going as a result of the podcast. I think, Liza, you've given us a lot of insight, a lot of food for thought, how we can bring bigger money to the table, basically, and also how this climate crisis could potentially look and start like a proper insurance crisis and a financial crisis, which is obviously a scary scenario. And let's hope we can get the money working before then to reduce that risk. But I thank you so much for today. It's been a pleasure to have you on the show. You've given us so much to think about, and I wish you a lovely day ahead.
Yeah, thank you. And thank you for having me.
Thanks for tuning in to ESG Decoded. We hope this episode has inspired you to take action in your own ESG journey, stimulating ideas for partnership and innovation.
New episodes drop bi-weekly on Tuesday morning. Subscribe now on your favorite streaming platform to stay in the loop.
Join the conversation on social media using @ESG Decoded or visit ClimeCo.com for more resources.
Until next time, keep decoding, keep innovating, and keep making a positive impact.